In today's session, we will be focusing on the accounting equation. What is accounting equation? Accounting equation forms one of the cornerstones of the subject that we are studying, which is business accounting. It is one of the fundamental, or it is one of the basic rules. It is one of the basic laws of accounts. So just like when we learn other disciplines, or let's say we have learned disciplines like physics, or when we learn disciplines like chemistry, we know there are certain basic principles. So for example, when we learn chemistry, we would have probably learned about Dalton's atomic theory. Okay? So the entire concept of chemistry is based upon Dalton's atomic theory. Or when we study physics, we would have studied some basic principles of physics. So we would have learned that energy neither can be created nor be destroyed. Energy can be converted from one form to another. So all these are what? These are building blocks, or these are building foundations for the disciplines that we are studying. Similarly, accounting equation forms the basis of the accounting subject that we are studying. Now, one important aspect is double entry system of accounting is based on the entire concept of accounting equation. Okay, or it is based on the concept of accounting equation. So probably the rationale that every transaction has got two effects. One is a debit effect, the other is a credit effect. That concept, that statement is based on accounting equation. It also forms the fundamental basis or the fundamental element with which we go about the preparation of the balance sheet. So earlier, probably in our earlier school days, when our teachers have taught us how to prepare balance sheet, there was one important rule they would have taught us. They told that at any cost, the asset must tally with the liability. But what is the rationale behind it? What is the logic behind it? Because the moment we prepare the balance sheet, basically we are validating the accounting equation. Okay? So we are validating the accounting equation because it has to validate the accounting equation. That's the reason why your assets must be equal to the liabilities. Okay, so that is the reason why assets must be equal to liabilities. So accounting equation, it forms the basic principle, it forms the foundation of double entry system. It is the basis with which we go about with the preparation of the balance sheet. Now, what else does accounting equation tell us? Accounting equation tells us that total assets is equal to capital plus total liabilities. Accounting equation tells us that total assets of a firm, it is equal to capital plus total liability. So that is the accounting equation, or this forms the cornerstone of the subject. So accounting equation states that total assets of a firm is the sum total of capital plus total liabilities. Okay. Accounting equation states that the total assets of a firm is the sum total of total capital plus total liabilities. Now, we know that there are different formats of business. We know that we have sole proprietor, we have partnership, we have a limited liability company, we have cooperative society, we have private companies. Now, in the case of a company, we can rewrite the accounting equation as total assets is equal to shareholders' equity plus total liabilities. Okay, so that is what is meant by accounting equation. Now let's move further. Let's talk about the composition of each of these aspects. Okay, what makes up your total assets? What makes up your capital? What makes up your total liabilities? Another way that we can go about rewriting accounting equation is like this: total assets is the sum total of current assets and non-current assets. Total liability, it is the sum total of current liability, non-current liability. Shareholders' equity, it is made up of share capital and retained earnings. But either ways, it has to fulfill the rule, it has to fulfill the law, and the law is that a total assets is equal to the sum total of total liabilities and total assets. Okay, so that is the universal law. Okay, or this is the basis of the subject that we are studying, which is the accounting equation. This is also the reason why when we learn how to prepare the balance sheet, our teachers have told us that the assets must be equal to the sum total of liabilities plus capital. Now let's discuss each of these components a little bit more in detail. Now the first thing that we are going to be talking about is the assets. What are assets? Assets refers to the resources which are used by a company, by a firm, and it is with the help of these assets that a business would be carrying out its routine activities. Okay, so some of the assets a business can have is land, machinery, raw material, etc. So these are some of the resources a business can be using. What does a business actually do? With the help of these resources, the business would be carrying out its day-to-day activities. Now, without the help of these resources, it's very difficult for the business to carry out its routine activities. And if the business is not able to carry out its routine activities, they are not in a position to generate cash. So assets are resources which are used by a business. It is used by a business to carry out its routine activities. Once a business carries out its routine activities, it is able to convert the material into cash. Now, what makes up the total assets? Total assets is equal to fixed assets plus current assets. Okay, total assets is equal to fixed assets plus current assets. Now, what are fixed assets? What are current assets? Fixed assets, it refers to the assets which are likely to be in a business for a fairly very long period of time. Okay. So assets which are likely to be in a firm for a fairly long period of time, that is referred to as fixed assets. Another way that we can talk about fixed assets is that fixed assets are those assets which cannot be converted into cash immediately. So for example, a business may have land, but a business wants to convert that land into cash. If there is a procedure that they probably might have to follow, they might have advertised regarding the land, sale of land. They have to find a suitable buyer. They may have to negotiate the price. Once the price has been negotiated, they may have to go to a registrar's office, get the deed, get the sale deed registered. So there's a lot of activity which has to be carried out. They will not be able to convert it into cash immediately. So fixed assets are those resources which are likely to be in a business for a very long period of time. And for you to convert fixed assets into cash, it takes considerable amount of time. Some examples of fixed assets are land, machinery, building, etc. Okay, these are some examples of fixed assets. Now let's talk about the current assets. What are current assets? Current assets are those resources which are likely to be consumed by a firm within a short period of time. Okay? You're likely to use up these resources immediately. An example that I can give you is raw material. Raw material you will be using in your business, you will be subjecting it to processes. The moment you subject into processes, you will be immediately converting it into finished product. So that's about the current assets. Current assets are those resources which are likely to remain in your business for a short period of time. Okay? Now, another thing about current assets is that you will be able to convert current assets into cash immediately. If you have a need, you will be able to convert it into cash immediately. For example, you lend money to one of your friends and he said, I will pay you back later. Now, after probably 2 days, suddenly you had a need for money. So you can always go back to your friend and then ask him to pay back what you had given them. Okay, so you're able to convert that outstanding obligation into cash immediately. So that's an example of current asset. Some of the examples of current assets that we can see in a business are stock, debtors, etc. These are some of the examples that of current assets that we can see in a business. So please remember, assets are resources. These assets can be broadly classified into two: current assets, fixed assets. Fixed assets, long period of time, and they cannot be converted to cash immediately. Current assets, you will be using them in short period of time. You can convert them into cash immediately. That's about the assets. The next topic that we will be discussing is total liabilities. What is meant by total liabilities? Liabilities refers to obligations of a business. These are commitments that you have to fulfill. These are commitments that you have with various stakeholders, and you're expected to fulfill. You're expected to keep up with a promise. Here's a deal. For example, you decide to go out with your friends for an outing, or you decide to go out for lunch with your friends. Now, it's only when you went out and after reaching the destination, you realize that you forgot to take your wallet. So what you did was you borrowed some money from one of your friends. You borrowed 500 rupees. Now, what is that 500 rupees that you have taken from your friend? It is an obligation. You will have to pay the money back. You have to give back the money. That is the reason why it is said to be obligations. So all obligations of a business, it is called as liabilities. Now, talking a little bit about liabilities of a firm, it can be broadly classified into two categories: total long-term liabilities, current liabilities. Okay, so there are two broad categories: long-term liabilities, current liabilities. Now, what are long-term liabilities? Long-term liabilities are obligations which the business has to fulfill at a period beyond 1 year. So if you have an obligation and that obligation you are likely to fulfill only across a long period of time, those obligations are said to be long-term liabilities. So for example, you went to a bank and you took a 20-year loan, which means you are likely to pay back the money only within 20 years. That is a long-term liability. So here, another characteristic about long-term liability is that the commitment, the obligation amount, it would be larger, or the amount that is involved when it comes to long-term liability, it would be generally huge. Okay? You would not take a 500 rupee loan for 20 years. Okay? Probably you might take a 50 lakh loan for 20 years. Okay? So long-term liabilities, please remember, these are obligations that you have to fulfill over a long period of time. Example, debenture. Example, long-term loan. Okay, so these are some examples of long-term liabilities. The next category of liabilities are current liabilities. So what are current liabilities? Current liabilities are obligations which a business is expected to fulfill within a period less than 12 months. If you have an obligation and you are likely to fulfill that obligation immediately or within a short period of time, such kind of liabilities are said to be current liabilities. Okay, such kind of liabilities are said to be current liabilities. Another aspect about current liabilities is that the amount, okay, the amount which is involved usually for current liabilities will be very small. It will be very small. Some examples will be bank overdraft, short-term loan. Now remember, long-term loan is a long-term liability, short-term loan is a current liability. Why? Because the tenure is very less. Okay? So that is about the total liabilities of the firm. The next concept that we will be discussing is capital. What is capital? Capital refers to the amount of money which is brought in by the proprietor to start the business. Okay? It is the money which is brought in by the proprietor to start the business. Okay, or it refers to the resources. Okay, it is referred to the resources which are brought in by the proprietor to start the business. Now, the capital, it can be in the form of money, it can be in the form of material, and it can be in the form of maybe goods as well. Okay, so the resources which can be brought in by the proprietor to start the business, that is referred to as capital. Okay, so that is referred to as capital. So total of all the resources. So for example, you decide to start a business, you decide to bring in some table of your own, or you decide to bring in some money of your own, or you decide to bring in some raw material, you decide to bring in your computer, you have a spare computer at home. So all these are resources that you've been bringing in to start the business. Now, when we talk about from a company's point of view, please remember we call that as shareholders' equity. Shareholders' equity again has got two parts. You have share capital and the other is the retained earnings. Now, what is share capital? Share capital refers to the resources which are contributed by the owner, by the proprietor in return of ownership. Okay? So you're giving resource, in return you're getting ownership of the firm. Okay? Sometimes what happens is you may not be in a position to start a business of your own. Your best friend might be starting a business, okay? And they might be inviting you to join them. Okay? So the idea is your friends, the business concept is that of your friends, you're just contributing some resource. Now when you're contributing resource, what happens is equivalent to the amount of resources that you're contributing, your friend may be giving an ownership of the company. So for example, Flipkart was started by Vinny Bansal and Sachin Bansal. So what did Vinny Bansal and Sachin Bansal do? They came together, they contributed the resources and they started the business. Okay, so that is what's the meaning of share capital. Now, remember, shareholders' equity has got one more component, which is referred to as retained earnings. Now, what is retained earnings? Retained earning refers to the portion of the profit which is kept aside so that you can reinvest that into the business. Okay? It refers to the portion of the profit which is kept aside and you're planning to reinvest. Okay? So your company has made some profit. Instead of utilizing the entire profit, what you decide to do is you decide to save some amount of money. Now, the some amount of money that you're saving, that you're keeping aside, that is referred to as retained earnings. The portion of the money that is kept aside, that is referred to as retained earnings. Okay, so that is about the accounting equation. Please remember, accounting equation is a sum total of the assets is equal to capital plus liability. That is what is meant by accounting equation.